If we see gold on a closing basis break above this resistance line right here, and it's at a pretty strong tack, a 53% angle, we could, and again, this is on an exceedingly long-term basis. I'm not talking about in a couple of days or even a couple of weeks or a month, but this would be towards the third quarter of this year to the end of this year. We could test 5,500. But of course, before we do that, this is the key mark to beat, which is the recent all-time record high above 2,400.
Gold has been on a remarkable surge lately, driven by various factors propelling prices near historic highs. Over the past 6 months, the price of gold has surged by approximately 20%, surpassing the $2,000 per ounce mark. CMC Markets recently suggested that a shift in Federal Reserve policy could trigger a decline in the US dollar and bond yields, potentially propelling gold prices to reach between $2,500 and $2,600 per troy ounce. GaryWagner, the visionary behind the gold forecast, has shed light on the intricacies of the gold market. Wagner shares his insights, focusing on long-term trends, envisioning gold potentially soaring above $5,000 by year's end, following a breakout. However, he stresses the critical importance of surpassing the recent all-time high as a precursor to this bullish forecast. From January 1971 to March 2024, gold has delivered an average annual return of 7.98%, trailing slightly behind commodities, which boasted an annual average of 8%. Notably, the annual average return of gold in 2023 spiked to 13.1%. In his analysis of gold's price behavior, Wagner delves into pivotal support and resistance markers. He underscores the need for the market to overcome the present resistance line to establish a bullish trend. Despite a proper pullback in gold prices at the end of April, bullish sentiment resurged this week after Federal Reserve policymakers hinted at potential rate cuts on the horizon. Now, let's delve into Gary Wagner's insights from his recent interview with Keto News. But before we continue, please consider subscribing to our channel and activating the bell icon for timely updates.
We'll get to a flag formation in a second. In terms of support and resistance areas, support is at 2,300, and that is a representation of this extension. I've got a basic fib extension. We use a fib extension if we're going towards record highs, all-time highs, because if we haven't been there before, that's one of the few ways to calculate it. What I've done is put an extension in that goes back to 2022, when gold is at about 1,800 up to about 2,200, this big rally. Then we look at this correction, which culminated a little bit below 1,900 and start charting from there. So from this point here at about 1,900, the extension that is a 618% extension comes in at 2146, 2216, and then the one-to-one relationship. In other words, if we look at this rally here and compare it to this rally here, that would culminate right here at about 2,300. That's why we're pegging support at this level. Jeremy, you are correct, because it was former resistance. Support and resistance are part and parcel of the same thing. So currently this same area is support, and we've got resistance at the 1.236 at 2405. It did exceed that on that run up to the new all-time record high, and then it's come down and found support at about call it 2,300. And so we want to look at these different areas. We also want to look at the ultimate extension, which is a 1.618. Now, this would be an exceedingly long-term market move, but I'll show you why that's important on the second chart. On this second chart, when we look at it, what we see is that we talked about when we first started the chart, this series, we talked about this compression triangle. If it broke out, it would indicate the market moving higher. In fact, it did. And then we talked about a flag formation right here, and we measured this pole to this pole. This was our extension. And the interesting thing is it came up right around here. It far exceeded that, but I'm kind of seeing another potential flag formation in that we've got our pole here, We've had a sharp decline from these highs right in here. And so if we see gold on a closing basis break above this resistance line right here, and it's at a pretty strong tack, a 53% angle, we could, and again, this is on an exceedingly long-term basis. I'm not talking about in a couple of days or even a couple of weeks or a month, but this would be towards the third quarter of this year to the end of this year. We could test 5,500. But of course, before we do that, this is the key mark to beat, which is the recent all-time record high above 2,400.
At the recent FOMC meeting, GaryWagner delves into speculations regarding potential interest rate cuts. He emphasizes the significance of the Federal Reserve's adjustments to its balance sheet in tackling inflationary pressures. Despite the Fed's ongoing withdrawal of liquidity from the money supply, they have chosen to slow down the pace of reduction by $30 billion per month. Wagner finds this decision noteworthy. He anticipates that if the Fed opts for rate cuts later in the year, it could have a bullish impact on gold. Such cuts might weaken the value of the dollar, making gold more affordable for foreign buyers and reducing the opportunity cost of holding gold compared to interest-bearing assets. From a technician's perspective, Wagner explores the notable shifts observed in the gold and silver market, highlighting various factors driving these movements. He emphasizes that alongside evident geopolitical concerns, the recent surge was notably fueled by a delayed response to Friday's jobs report. This analysis aligns with Monday's market activity, where the spot price of gold increased by 1%. Investors are still digesting the economic implications of the latest jobs report, which fell below expectations. Additionally, they are considering the Federal Reserve's decision to maintain interest rates at current levels until further inflation easing. Now, let's return to the interview.
What I found most interesting about today's move in both gold and silver, where we had solid moves to the upside, is at first analysts were looking at this, besides the uptick in geopolitical concern with what's going on with Israel, was a delayed reaction to the jobs report that came out on Friday. In fact, on my weekly show and the weekend review, I talked about that it was perplexing that the jobs report came in the way it did, meaning that it certainly came in well under expectations, and we didn't see a sizable move in gold. In fact, we saw the opposite, and the same with silver. This is silver on Friday. And it didn't quite jive with what we should see. In other words, there are certain relationships that we look for, and those relationships get tested every time a new substantial data point comes out, and the jobs report is an exceedingly important one. We didn't get that on Friday, but we certainly got that delayed reaction today. And that, coupled with an uptick in geopolitical concern, is really what moved the market substantially higher in both gold and silver. And realize that during the FOMC meeting that recently occurred, they left interest rates unchanged. B, they talked about that they really need to see something in terms of movement before they consider cutting rates. They might have less rate cuts. Most analysts are penciling in 1 or 2 rate cuts. I still believe that they'll try to squeeze in 2.
Okay.
But that could be an incorrect assumption. The one thing that you want to look at when we look at something like this is how all of these markets work together, and the dollar being absolutely sensitive to statements by the Federal Reserve. And what was most interesting about what we saw was that although they did not cut rates and they left them where they are, they made an important announcement about their liquidation of their asset balance sheet, because the Fed has been pulling money out of the money supply at about 95 million, I believe. It could be billion.
Yeah.
The numbers are so large, they confuse me sometimes. $95 billion per month. And so what they said is that they're going to continue to pull money out of the money supply, liquidating assets from the balance sheet, but they're going to do 30 billion less per month. So they're only going to be contracting the money supply by 65 billion rather than 95 billion. So they're still contracting, but they're leaving an additional 30 billion per month that they weren't leaving in prior to that. And that's an important thing that the Fed has done, because aside from interest rates, that is the other effective tool in their toolbox to deal with inflationary pressures is balance sheet reduction, QT, or adding to the balance sheet, which is QE.
Goldman Sachs suggests that should the U.S. 5-year credit default swap CDs spread widen by 1 standard deviation, there's a potential for gold prices to surge by an additional 14%, reaching $3,080. This surge would be fueled by central banks acquiring an additional 6 million troy ounces of gold annually. As we explore the intricacies of the gold market, what factors do you think will significantly influence gold prices in the months ahead? Moreover, how do you intend to position yourself as an investor? Share your thoughts in the comments below. If you found this video informative, remember to support our channel and enable notifications to stay updated on our latest content. See you in the next video.